Hello, good evening, and welcome to this Integrity 365 webinar. We're going to be looking today at investment markets in 2024. So this presentation looks back at what we've learned from investment markets historically and what to expect for the year ahead. While we're just waiting for a few more to join our call today, I'd just like to take the opportunity to highlight our webinar series, which is available to playback on our website or via our YouTube channel. Just to let you know, this session will also be recorded and we will get a copy out to you all over the course of the next week. It will then also be on our website and YouTube channel, just in case you miss anything. I'd like to point out that everybody on the call will have the ability to ask any questions. There is a Q&A button or there is the chat button. So me and Billy will be able to have a look at those and we'll endeavour to answer as many of those questions at the end of this webinar. By way of introduction, for anybody that doesn't know me, my name is Debbie Packer. I'm one of the founding financial advisors at Integrity 365. And I'm delighted this evening to be joined by Billy Hughes, who's Joint Head of Professional Advisor Services and Portfolio Manager at James Hambro and Partners, where he has been for 12 years. So we've been, just as a little bit of background, we've been working with James Hambro ever since Integrity 365 launched. They've built a really strong performance track record. And they provide key information for us and for our clients, which we're always very grateful for. James Hambro and Partners was established in 2010 and currently manage over 5.5 billion in assets. They offer clients a global approach to investment management and have 31 investment professionals, of which we're joined by Billy, who's one of those. As Integrity 365, we're immensely proud of our independent financial advice offering. It's refreshing to know that 88% of James Hambro and Partners as a company is owned by staff working within the business. Their independence means that they are free from any external influences and can continue to operate in ways that are meaningful to us and our clients. So with no further ado, I'd like to hand over to Billy and start with posing a question that's on a lot of our minds at the moment. So Billy, what has been the story for the markets this year?
Well, thank you very much, Debbie, and thanks everyone for your time this evening. I will quickly just share some slides so I can illustrate my answers. And Debbie, hopefully you can see the slides. Hopefully everyone can see the slides. And first slide there. So Debbie, thumbs up, you can see everything?
Absolutely, clear as day.
Brilliant. Brilliant. So yeah, thanks for your time, everyone. Very much appreciated. And Debbie, thank you very much for the very kind introduction. So what has been the story for markets this year? It's all been about resilience. So as a reminder, and I'm sure you're all very aware, last year was very much about rising inflation and interest rates being hiked higher by central banks in order to control the rise in inflation. Now, what usually happens when interest rates rise to counter inflation is that a byproduct it is a slowdown in growth, or the big R word, which is a recession. So I think going from last year where rates were, interest rates went from around 0 to about 4.5%, 5%. Many were expecting economies, the UK economy, the US economy to slow or to grind to a halt and actually decline in value or in growth and recessions to materialize. But we haven't seen that this year. And I think that has surprised many. So despite interest rates being at their highest level in 15 years, we are not yet seeing any signs of recessions or any signs of slowdown. So to put that into context, the growth in the UK, the last quarter was flat growth, so 0%, which is not great, but again, it's not negative territory. But in the US, the growth on the quarter was 4.9%. So that's pretty strong growth in the world's biggest market. And that's despite very high interest rates, high cost of capital, mortgages, etc., etc. So things going quite well over there. So why have we seen the resilience? Two points really, and we've seen resilience in economies mainly because of the strength of the consumer. So the consumer, by and large, came out of the pandemic in not bad shape. I know that's a sweeping generalization, but monetary policy was easy, so interest rates were very low. The cost of borrowing was very low. Many people fixed their mortgages for if you were lucky enough to fix your mortgage for 5 years at a very low rate. Then that has helped. And government spent a lot of money on fiscal spend. So what that has meant is that the consumer, despite raising rates, has had enough money in their banks, in their savings, to withstand the rising inflationary pressures. And I think it's also helped this year that the price of oil and energy has not actually gone too much higher. In fact, the price of oil has declined over the year. So that has helped with energy costs and heating your home, powering your car, or companies when they're powering the labour force, etc., etc. So two reasons as to why we've seen this resilience. But I think the key message this year has been very much that inflation has started to slow. So let's just think that we saw peak inflation in the US in November last year at around 9%, peak inflation in the UK at around 11%. We've seen that decline to 4.7% in the UK and 3.2% in the US. So interest rates rising is starting to have an impact on getting back to price stability, but we are yet to see inflation come down. It's trending down, but it's still uncomfortably high. So the question we've asked ourselves is, interest rates have risen, inflation is starting to come down. Can we get away without a recession? Or will we get a more mild slowdown? They're the questions that we're asking ourselves for the outlook for next year. But I think the key points and why markets were so unsettled last year, where there were two outcomes that rising interest rates usually end up in. Or the two bad outcomes for rising interest rates and slowing growth is stagflation. So that's last seen in the 1970s. That's negative economic growth, rising unemployment, and high inflation. That's a really bad environment for most asset classes. I think we're out of the woods on stagflation. That there's no real signs that we're seeing anything like that because inflation is starting to come down and economic growth has been quite robust. And also, I think we can discount a more severe slowdown, a more severe recession. So I think that's what many people were worrying about. We're not seeing signs of that yet. I think we're just seeing signs of a moderate slowdown, if a slowdown at all. And that has been a resilient story this year. And equity markets, by and large, have done okay. There's been a lot of concentration around AI hype, artificial intelligence, which we'll come on to talk about a bit more. And bonds have been okay. They've started to pick up recently in value, but again, something we'll come to talk about a bit more. But in terms of when we do start to see peak interest rates and peak inflation, which we think we've seen peak inflation, we think we're close to peak interest rates, i.e. they're not going any higher, then I think it's easy to paint a picture for a stronger decade over the next decade of growth ahead. So if you look at the amounts of money being spent on fiscal stimulus, so government putting money back into the economy, there's $1.7 trillion in the US being spent over the next decade. There's 750 billion euros being spent in Europe. And I think that money is being spent on the energy transition, supply chain security, post the zero COVID lockdowns in China and the pandemic, which caused huge supply spikes. The excitement around productivity growth and AI and tech innovation. So there's lots of reasons to be comfortable about future growth. I just think we need to get past this interest rate inflation dynamic in the UK, US, and other developed markets. Hopefully that gives a good picture of where we are and where we're going to, Debbie.
Yeah, thanks, Billy. That's really helpful. Another question. Do you think inflation will get to the Bank of England's 2% inflation target?
So I think that it will get there, but it might be a bit more bumpy and slower than we expect. Central banks, both the Bank of England, Andrew Bailey, Jerome Powell, the Federal Reserve, the ECB, they've all had the opportunity over the last couple of years to change their 2% target. The fact that they haven't, I think, tells you that they're really keen to get price stability back, so we'll get back to the 2% target. But I do feel that A, it's going to be a bumpy road, and B, what is different from the last decade, I think the next decade, there is an argument for structurally higher inflation. So as a reminder, and I'm sure you're all aware, over the last decade, central banks were stimulating economic growth by having low interest rates, really, to try and A, get economic growth, but also B, make sure we weren't in a deflationary environment, so the opposite to inflation. Now, with aging demographics, so the world is getting older, that's less people in the workforce, and also coupled with a transition to a cleaner energy environment, I think there will be signs of a green premium to get to that sustainability. I think there's elements of deglobalization where Western companies and consumers have benefited from cheaper labor and supply chains over in developing markets. So deglobalization is potentially something that we have to consider. So yes, I think we'll get back to 2% at some point, but I wouldn't be surprised if it's between 2 and 3% and structurally higher for the longer term. In the UK, we're a bit more concerned because our inflation is coming down at a slower rate than the rest of than other developed markets or other OECD countries. So we're at 4.6% inflation CPI. That's last month. That's down from 6.7%, but there's still a long way to go. And Andrew Bailey, the governor of the Bank of England, came out at the weekend and said, clearly the fight against inflation is not over, and it will be a battle to get back to 2%. So he's really signalling that there's going to be no interest rate cuts, so no cheaper mortgages, I'm afraid, for the time being. But yes, I think at some point we will get there, and it's that in markets and bond markets, equity markets, and how your portfolio performs. Getting to between 2 and 4% in interest rates and inflation is actually quite normal. If you exclude the last 12 years where we've been in an experiment of quantitative easing, where monetary policy has been very low, over thousands of years, you should have to pay to borrow money. That is the convention of how things should be. So if we go back to normal, where interest rates are a little bit higher and inflation is a bit higher, that leads to good capital allocation decisions. It leads to good outcomes for investors. It's removing the uncertainty that we want. We don't want to have to worry about inflation going from 0 to 10 to 5, like we've seen in Argentina, in Turkey. That's not good for investors. We want price stability back, and I think that's what central banks are committed to do.
Yeah,
hopefully that answers your question, Debbie.
It does, and it's all about that consistency, isn't it? And
Absolutely.
I mean, just leading on from that, there's been a lot of talk about equities being expensive, particularly, given high interest rates and high inflation. What would your thoughts be, Billy, about sort of equities being expensive at the moment in comparison to maybe where they have been before?
Yeah, absolutely. It's a great question. I'll come on to the next slide if I may. So At a headline level, equities they had an okay, pretty poor year last year. Let's be honest. Bonds had a much worse year, and we can come on to talk about that a bit later. But equities have done okay this year, but at a headline level. So this chart here that you can see, the red shaded. So this is the S&P 500, which is the US index. So basically, it's a US index that tracks lots and lots of the biggest US listed companies. The red shaded area shows you the returns. So as at the end of September, the S&P, so the S&P index is up 10%, say. The red shaded area shows the contribution of that performance from just 7 companies. And I'm sure you're all aware, and you've read the financial press or the Sunday Telegraph Times, the Magnificent Seven, as they're being called. So Amazon, Meta, Alphabet, Microsoft, Nvidia, Tesla. Those 7 companies have driven returns this year. So the red shaded area shows that. And some of those companies are expensively valued. So when we look at valuation, we look at the current price versus future earnings. And that to us is a good mechanism to find out if something's cheap or expensive. A higher valuation, more expensive, has a greater impact on future earning, if your future returns. Lower valuations are cheaper and potentially better entry points. There's lots of other factors at play, but let's keep it very simple. So these Magnificent Seven technology companies have driven returns this year, and you can see that by the chart. Now, a lot to do is in relation to artificial intelligence, and that's other than that, these companies are pretty good companies. They've got solid business models, and they are still growing. Which the like for like, or the comparison with the .com era is different, because these companies are proven and they're making profits and they're well run, or some of them are well run. So the returns this year have come from these companies, and that's generated basically through artificial intelligence, which we need. Let's be frank. The world is aging. We haven't had any productivity growth. So productivity growth is sort of what me as an employee of James Hambro and Partners does per day. If I can boost that productivity alongside the rest of the UK contributing to the UK economy, then we will grow more and more. And studies have shown that artificial intelligence boosts a person's productivity by up to 40% versus someone that's not using AI. So very early days, but that's why we've seen the hype this year. The opportunity for us, and we do own, let's be clear, we own Amazon, we own Microsoft, we own Alphabet, great companies. The opportunity for us is the rest of the market, which is the grey area, has actually lost value this year. And those companies, so 400 in relation to the S&P, that's 493 stocks. In aggregate, those companies have lost value. And actually, those companies' earnings have been pretty good year to date. So what that basically means is that those companies have got cheaper. So the grey line here is the important bit and the opportunity. And if I go on to the next chart, now this chart looks very confusing, but I'll try and keep it very clear and simple. So you only need to concentrate on the blue line at the top, the high line. That's the tech index in the US. Very expensive in terms of valuations. More expensive than its 10-year average, which is the corresponding blue dotted line. Now, the grey line at the bottom neutralizes the impact of the largest companies in the world. So it neutralizes the impact of Amazon, Alphabet, Meta, who own Facebook, etc., etc. That world index is cheaper than it has been on a 10-year view. So that basically gives us some pretty decent entry points from here for future returns. So although headline equity, the headline equity indexes look expensive, actually there are pockets of value, and I think that should give us, corresponding to the the long-term drivers I mentioned at the start should give us a decent opportunity to make returns over and above cash and inflation over the next few years. So a bit misleading looking at the headline. There's pockets of valuation elsewhere, both in the US, in the UK, Europe, Asia, etc., etc. Hopefully that answers your question, Debbie.
Excellent. No, it does, be. The slides are really helpful, and I think it just demonstrates the importance of picking the right funds at the right times. So again, that leads on nicely. So okay, so that covers equities and costs and markets in equities. But what about our clients who maybe want to take a little bit less risk and balance that out with maybe bonds and fixed interest? So would you consider bonds to be a good investment at the moment?
Yes. So we have spoken a lot about equities, and from our perspective, equities should drive the longer term returns in portfolios, and bonds should essentially have two jobs. And I'll explain the slides in a second, but the two jobs for bonds really should be to provide a real return, so a return over and above inflation, but also provide protection and be a safe asset class in times of financial stress. So bonds and equities sometimes, not always, work in different correlations, but really when equities struggle because there's financial stress, bonds should be there to prop up your portfolio value. So a safe investment. That didn't happen last year. So the UK bond or a UK gilt, one of the perceived safest asset classes out there, fell 24% last year, which is, that's a once in a lifetime fall in asset class across asset classes. Now, that was very much to do with the interest rate and inflation dynamic, and I definitely wouldn't expect that dynamic to repeat itself often. So I think we can rest assured that bonds do have value, but we just need to make sure that inflation doesn't get out of control, which is not what we're seeing, because we're starting to see it trend down, because inflations are a bond's worst nightmare, essentially, because it disrupts the value of the fixed return you get, but it also likely means interest rates will rise. And as interest rates go higher, the bond's value goes lower. So they work in inverse ways. So to explain the charts, on the left, you basically lots of detail here, but what we're seeing here is that each line going on to 2022, 2023, a bond has a yield. So it's basically what you get back from that bond when you put your money in. And the safest government bonds, so UK, US, Eurozone bonds, are now yielding, so basically giving you back per annum rates that we've not seen for a decade plus. So back to 2008 was the last time we saw the return from bonds like this. So we as an investment house have been underweight bonds for about a decade. We now have added back into bonds in our portfolios because leading on, not only, so going back to that dual mandate, A, they should give you a real return, and B, the chart on the right shows you bonds give you a good return, usually in times of financial stress. So during the global financial crisis, so when back in 08, 09, you saw a 30% return from just a UK government bond over that period. So you get a real return from bonds now, and they protect against volatility in the downturn. So consider this, and this stat is quite amazing. US government bonds, so probably the most important financial number that we use and that we know of. US bonds at one point last month yielded more, so are more attractive in terms of what they give you back than emerging market debt, which is usually quite risky, and Greek debt. So that shows you how exceptional the last couple of years of returns have been in terms of poor returns for US and UK debt. And that shows us that the opportunity is here for bonds going forward, because US bonds have never lost value in their history in 3 consecutive years. And they've lost value this time around in 2 consecutive years. And of course, things could be different, and we'll wait to see what happens over the next month or so. But I think we're starting to get to that point where bonds are giving you pretty decent value. Critical for low risk investors, I'm sure, and good to know what the expected return is going forward. Hopefully that answers that one, Debbie.
No, that's great. And again, you know, it is all about that balanced portfolios and not having all of your eggs in one basket. But obviously, we day to day we speak to a lot of clients that are generally just looking to maximize their returns. And as returns have improved for cash, you know, you see a lot of headlines saying cash is king. You know, is it right that there are alternatives in the current environment? You know, should clients be moving to cash, or is it about that diverse approach?
Okay, so I'll come onto the slide in a minute, but this is sort of stepping on your toes, Debbie. So I'll be quick. But from an investment standpoint, to meet short-term liabilities, so mortgage repayments, holidays, weddings, son and daughter's weddings, something within the next year, 2 years, sometimes 3 years. Cash is a fine asset class, and you should do whatever you can to meet that liability and go and maximize the returns you can get on cash. You can buy government bonds, but government bonds will give you a risk-free return, and that's helpful. And the gain on the government bond is tax-free in the UK if you're a UK taxpayer, etc., etc. But if you want to build and preserve wealth over any time longer than 3 years, whether that's a pot to pass down to beneficiaries, whether that's to pay off your mortgage in 15 years, whether that's to retire, etc. Bonds and equities, history has proven that they beat cash, they beat inflation over any considerable time. So let me go right back to sort of fundamentals. Cash is perceived to be king and is perceived to be a low risk asset class, and equities and bonds, quite rightly, are perceived to be more risky. Now, because of inflation and the power the erosion of the purchasing power that inflation has on your cash. So over time, your £1 today is worth not £1 in a year's time if inflation's running at 10%. It's worth 10% less. Because of that purchasing power impact that inflation has on cash, the longer you hold cash, the more risky it becomes. Whereas the longer you hold bonds and equities, the less risky they become. And your greatest advantage as an investor is time. So the longer time horizon you have, the more chance you have of meeting your financial objectives. So preserving, building wealth, bonds and equities, history shows that, and this chart shows that. So this shows the real returns. So real returns basically is the return you get after taking into account the impact of inflation. So really, it's what the return can buy you. The blue bars show the real returns for a bunch of assets. The grey bar shows you the nominal returns, which is not taking into account inflation. But we're concentrating here on the blue bars. So what you can see here is that in real terms, taking into account inflation, over the last 22, 23 years, cash has returned you 0.04%. Bonds, UK gilts have returned you just over 1%. The UK market, the UK FTSE 100 has returned you 2%, just over. But actually, if you look at the MCSI world and the US market, that's returned you in real terms over 5%. We think that having a balance of bonds, a bit of cash, and a balance of and equities too, we can then build a portfolio that preserves and builds wealth over and above inflation over the longer term. So cash might be king, but market timing is incredibly difficult. So if you consider you have to remain invested in these asset classes in order to get the return. And if you consider that over this time period, the MSCI World gave you a return of 197%. So the world equity market gave you a return of just shy of 200% over that 23 year period. If you took out that money for just 30 of the market's best days, so where the market was climbed the highest in that period, you would have returned at minus 19%. So the message is stay invested if you want to preserve and build wealth in real terms, and that is where the real value lies. So if you've got short-term liabilities, cash, bonds, meet the liability, fine. But over the long term, it's a good asset class, equities and bonds, to build that wealth.
Brilliant.
Hopefully that helps.
Definitely. And yeah, very, very interesting stats there. Just 30 days can make a huge difference.
Absolutely.
Obviously, being in the UK, as most, if not all of our clients are, the UK market sort of stands out versus world markets. So can you comment, Billy, on maybe the returns for the UK market going forward?
Yeah, absolutely. There's a lot. We're obviously we're UK based companies. On the whole, we'll be dealing with UK based clients that are spending sterling predominantly. Let's make that assumption. So we've got to be wary of that. We can't have all of our eggs in one basket. Diversification is key, and this chart shows you that the UK has not performed as well as other markets. It's easy to sort of beat up the UK, but let's put some facts and figures around, let's get away from opinion. Let's put facts and figures down. So since the end of 2019, the UK economy has grown 1.8%. That's versus 3.4% for the European Union, so the European Union area, and 7% for the US. Now, everyone's had a different COVID period, and let's try not to draw comparisons, but I think there's a reason why the UK is the cheapest, arguably the cheapest asset class in the world. And I think if you're going to invest in the UK, it's important to understand why it's cheap and what the catalyst for any improvement is. So really, what has happened? Brexit has probably not helped. We've had a less good relationship with our biggest trading bloc. Politically, there has been lots of change at the top. It seems at the moment that there has been a bit more of a sensible and grown-up approach, but the last two prime ministers we had in place, not great for investor sentiment. We all know what happened last September with the sort of so-called mini budget. Another key thing, we're not energy self-sufficient anymore. Now a lot is trying to change, whether through clean energy or through oil and gas. But that had a massive impact on us last year. We were heavily reliant on gas from bad actors, and that had a huge impact on our economy. Our currency is a smaller currency than it used to be, and is more volatile. And if you think that the UK market is only 3%, so the UK listed stock market is 3%, 3.8%, sorry, of world markets. We're unfortunately we're a smaller fish than we once were. That's probably because the likes of the US, China, emerging markets are growing, and good luck to them. But that's why we feel that the UK market is undervalued. The cheaper the UK market gets, the more its companies have to pay to raise capital. So from an investor sentiment point of view, it unfortunately at the moment is moving in the wrong direction, and we're an undesirable place. You only have to look at Shell, the oil company, recently looked to relist in the US. Arm is looking to list in the US. That's a UK-based company that's coming out of private ownership. Hotel Chocolat recently bought by a US company. You look everywhere, there is a de-equitization. What that basically means that there's less and less good companies on the London Stock Exchange. Now, that's not to say that things are always going to be like that. So let's consider that over the last 20 years, UK pension funds and institutional investors have pulled about 2 trillion out of UK markets. Now that could change. So catalysts for improvements would probably be more clarity over and less regulation around trading blocks, more stable leadership, regulation to change how pension funds work, how ISAs work, as in can you, if you put an extra £5,000 in, you invest that into the UK, that will help. But these are all things we're waiting to see. The UK market is cheap. We have a modest exposure here. We prefer to invest in greater opportunities overseas, but that could change and we could become more constructive on the UK in due course. Next question, please, Debbie.
Brilliant, thank you. So again, just talking about that balanced portfolio then, Billy, what do you see over the next year and onwards then? So somebody's got a well spread, well diverse portfolio. What do you think the tale will tell over the next year and beyond?
Let's be honest, but balanced, or unless you've been very lucky and own certain companies, most investors have had a pretty torrid time over the last couple of years. It's not, it's not been a great environment with rising interest rates and inflation and wars, etc. So the key thing here, I think, is that there is light at the end of the tunnel because we're starting to see inflation trend down, and we've spoken about that. But JP Morgan, the bank, released a strategy paper recently where they expect a balanced portfolio, or to be precise, 60% in equities, 40% in bonds. So a balanced portfolio, give or take, to outperform cash and inflation by between 4 and 4.5% over the next decade. So we've had that reset over the last couple of years of bad returns. Let's not forget from 2010 to 2021, returns were pretty good. We've had that reset. Pressure's been let out the system. We're at a more normal interest rate inflation dynamic. I think we can expect returns to be okay from here. And if I just, in the interest of time, I'll just quickly go on to what we think. So the first, in terms of returns and how they're driven, the first year is usually driven by, investor sentiment and hype around certain areas. Year 2 to 5 is driven by the business cycle, the economic cycle, so sort of peaks and troughs and cyclicality and interest rates rising and falling, etc., etc. Year 5 onwards is driven by earnings. So earnings essentially are what companies generate over the longer term. And if earnings can grow because we're investing in the right companies, those companies are taking share of their competitors, but they're also benefiting from sectors that themselves are growing, then this chart here shows you what that impact of growing earnings has. So the blue area is the growth of company earnings, so the revenue growth that they generate, those companies, whether in the UK, US, etc. The black line is the S&P, again, the US markets shareholder return. So when earnings grow, that correlates with positive shareholder return. So we think that with the companies we invest in, we're sort of forecasting, the market's forecasting for the companies we're invested in, earnings growth between 10 and sort of 15% over the next 4 or 5 years. Now that's going to be very bumpy. We know that there's always going to be hurdles in the road, but I think that's quite a compelling place to be for the equity exposure, to beat cash, to beat inflation. And when you factor in the attractiveness of bonds at the moment, we're quite constructive going forward. We just need to get past peak inflation and interest rates. But I think that the worst is behind us, and for a balanced portfolio going forward, we can expect some better returns, but definitely a bumpy road. But there's signs to be, there's light at the end of the tunnel.
Excellent. And I mean, earlier, Billy, you spoke about artificial intelligence, AI. Are there any other sort of nuggets that you think will drive returns over the next few years?
Yes, absolutely. So we always look at companies on a sort of a 5-year plus view, and these are some of the companies that we're currently investing in. But take a step back from that. we think that AI is, a fantastic opportunity. Difficult to predict who's going to win. I think it's so fresh and so new that there will be companies that will be losers and there will be companies that will be winners. It's our job to find the winners. But there are other multi-year themes. The adoption of cloud and IT spend. There's a lot of runway as people adopt. Companies go into the cloud. They use Azure, Microsoft's cloud. They use Amazon Web Services, etc., etc. But there's, as I mentioned at the start, economic resilience. I think governments very concerned about securing supply chains and reshoring and bringing jobs back onto their own soil. $1.7 trillion is a lot of money to be spent, and that's got bipartisan support in the US, by the way. Some elements might be a bit contentious, but I'm not going to comment on Biden or Trump, but this is going to be a longer term amount of money that's spent on infrastructure, on building factories, on regenerating growth in the Eurozone and in the UK and in the US. So economic resilience will be a key theme. Healthcare innovation, I mentioned that we're all getting older. So that basically means that we not only at the working age going into the older age, but the older age are living longer. So we need to be more beneficial so we need to be more innovative and productive on healthcare. Drug approvals are increasing. AI is helping out there. For instance, weight loss drugs. Apparently, I can eat whatever I want at Christmas now and take a drug, and I'll be a lean bean by the end of January. There are plenty of interesting companies there. The emerging market theme is that there's plenty to go after. Cleaner energy. There's lots to be excited about over the next 10 years. Lots of areas of growth, but not concentrated in just 7 or 8 companies in the US. We need to think better than that, and we can buy in at better valuations to get pretty excited about what's to come. But it's going to be a bumpy road, we think. But there's enough to be opportunistic about.
Brilliant. Thank you. No, that is excellent. And while we've been talking, there's been a few questions that have popped in as well.
Excellent.
So
if you don't mind, I'll stop sharing the slides now.
Yeah, that's great. No, thank you. Thank you. I particularly like the idea of being able to eat what we like over Christmas. So I've got a few questions. We might not have time for all of them. But first one on my list, how do you think a change of government in the UK could impact investment strategy?
Great question. Typically, and I'm assuming we're talking about Labour coming in, let's use that as the sort of as the base for the answer to this question. Typically, markets don't love a Labour government, and I won't comment on the political stance, but I'll just give an unbiased view on markets are a bit scared about what Jeremy Corbyn would do with companies and sectors, etc. I think over the longer term, politics doesn't have any impact. It doesn't have a long term impact on market direction. But of course, it's on our radar. The Labour government currently is sort of seems to us is hogging the centre ground. Taxes are already at 70-year highs. I mean, 30% of our national income goes on tax. I think we'd be at breaking point if taxes go any higher. There's not been a great deal mentioned about nationalisation of companies, corporates, etc. And it seems to be that Labour are building closer ties with businesses and folk. The important thing is both Conservatives and Labour know that we need to start growing again. Of course, there will be a lot of noise over the next year up until I think the deadline is early 2025, but not too concerning as things currently stand. And I wouldn't count off the Conservatives because we know what the polls do, and it's very hard to predict any sort of outcome there. But a very political answer for a politically based question.
No, that's great. No, thank you for that. And just one more, the impact of currency fluctuations on a sterling-based portfolio. So what comments would you have on that one, Billy?
So very quickly, within fixed interest and the alternatives part of a balanced portfolio, we hedge. This is what we do. We hedge currency. So we negate the impact of currency movements. Currency movements can have a big impact, but it's very difficult to call currencies in terms of what sterling's going to do against the dollar, et cetera, et cetera. You can forever get that wrong. We take the view that we leave our currency exposure unhedged in equities, mainly because if you're buying companies, they are usually operating in economies that are growing. And when economies grow over the longer term, the currency is usually fairly stable. There are question marks about the challenge of Bitcoin, stablecoin, the renminbi, the Chinese currency, versus to challenge the dollars as a reserve currency. I can't see that happening anytime soon. So the message is let the currencies play themselves out. Sterling, for a sterling-based investor, if you look at the chart of sterling to dollar, that's sort of the key one. A long time ago, you could get $4 to £1, and at one point last year, it was nearly parity, 1-to-1. So there's a clear trend there. Of course, if we start to see a much stronger sterling, we will have to visit that, but it shouldn't really impact our performance. Something we're conscious of. We know what we've got the tools to know what the impacts are going to be, but something that we don't get overly involved in predicting.
Excellent. No, that's really helpful. And we have got a few other questions, but unfortunately, I think we have run out of time because it's such a hot topic. So we will endeavour to answer everybody's questions thereafter. I guess all is to say from me is thank you so much, Billy. Really, really appreciate the updates today, as I'm sure everybody on the call and beyond this call will do as well. On that, we are recording this, so we will pop this on our website. It'll be available on the YouTube channel as well. All our previous webinars are on there. And again, for everybody that's attended this evening, there will be a feedback form as well. I also want to extend a huge thank you to all of our clients, all of our business eco partners and colleagues who have supported us all through what has been quite a tough year and few years, in fact. So yeah, really appreciate everybody's support there. I'm sure after hearing all of your words of wisdom tonight, Billy, that the year ahead will be one to look forward to. So thank you so much. If it's not too early to say, I just want to wish everybody a very happy Christmas, a safe and prosperous new year to you all and family. And again, a big thanks from us, Billy, as well for the presentation this evening.
Thanks for your time, everyone. Thank you, Debbie.
Take care. Bye-bye.